U.S. stocks largely lower after hotter than expected January inflation reading. Here with the trading day takeaways is Yahoo Finance's Josh Schaefer.
Josh, we got to start with that January CPI report because it came in hotter than pretty much everyone expected. So it was hotter across the board. What I want to take a look at here is sort of the trend that we're seeing in inflation. So, of course, our 2% target hanging out here in the orange. We're still well above that, of course, right? But also looking at the blue line here, year over year inflation, CPI coming in at 3.3%. That's a move up from where it was in December. Also a move up from where economists had expected. Economists actually thought it would fall. And then you look at the two trend lines I put in here with the white and the green, sort of your 3-month annualized, your 6-month annualized, the more recent trends. Those are heading significantly higher, Josh. And so the takeaway from this report essentially being, well, if we've been worried about the prospect of maybe higher inflation later this year or once Trump tariffs come into play, some of those other factors people have been watching, there might be a little bit of an inflation issue for the Fed just right now with how the data is going. So I was surprised actually to not see the market sell off as much as it looked like it was going to this morning, but clearly all eyes were on this print and there wasn't a lot of great takeaways from it to move forward.
So that was CPI. What about PPI tomorrow?
Yeah, so tomorrow we'll get the producer price index. Economists right now expecting that wholesale inflation actually also increased in January. And so the key reason, Josh, that we're talking about PPI tomorrow morning is once we get PPI, we get CPI. Fed Chair Powell was talking about this today. It gives you a pretty accurate reading of PCE. A lot of acronyms today, but that's the Fed's preferred inflation reading. So by about 9 a.m. tomorrow, we should have a good read on how economists feel about the Fed's preferred inflation reading for January, which will come later this month. But overall, it seems like more signs of sticky inflation probably expected tomorrow morning, probably expected for our inflation readings later in the month, which is why we get to takeaway two. Takeaway two, markets pricing in just one Fed rate cut for the first time this year. So what we're looking at here is different forecasts of where the Fed was headed. Green was back in December. You can see we've just sort of been ticking up, right? So this white dotted line now, that's only projecting the Fed moves once this year. Entering today, before this print, the debate had sort of been, maybe May, maybe June, then maybe they go once more. Right now, it seems like economists taking today's reading and saying, I think maybe the Fed cuts once if they cut it all this year, Josh.
What's interesting is there were economists and strategists, including someone on our show today, who was saying they thought the Fed is done cutting in 2025. It's done cutting. If that was true, Josh, what do strategists say, okay, if that was true, what would be the knock-on effects? What would it mean for the stock market?
Yeah, so right now, I think the key thing is that markets still feel like the Fed is either not cutting or leaning toward cutting, right? Once we feel like markets feel like the Fed is leaning toward hiking, then you might have a little bit more of a market sell-off than we saw today. But I'll point out one thing. You were just referencing what Michael Kantrowitz was telling you, right, about the fact the Fed might not cut this year, but he still seemed relatively sanguine on stocks, right? He said maybe we get single-digit returns, which isn't bad. It's not negative, right? But what was Michael talking about when he told us that? He's talking about the 10-year Treasury yield, right? So we're at 4.6% now. You can see we've moved up pretty heavily in recent weeks, but notably we're still well below 5. And we're still below 475. So I think this is going to be the key thing to watch. If these readings continue to come in hot, we continue to price out rate cuts, maybe we move to rate hikes. If your 10-year moves closer to above 475, headed to 5, then you might be more worried about stocks. Right now, strategists largely say if you're in large cap companies that aren't exposed to perhaps refinancing risks like some of those smaller cap companies, then maybe you're still in good shape. But overall, a more bifurcated return for the stock market as we sit with rates pushing higher.
All right, PPI tomorrow. Thank you, Joshua.